Welcome to another episode of Building Your First Home. Today on the show we have Nadia Davison, the Director of Results Home Loans. Nadia has an impressive wealth of knowledge in the world of property and finance. Her family business, founded by her dad 20 years ago, provides a range of services including financial planning, accounting, self-managed super funds and mortgage brokering. Nadia has recently started mentoring other brokers, helping them grow and succeed in their careers. Having built homes and bought established properties herself, Nadia has a unique perspective on the entire process, making her the perfect person to help us explore the differences between building a new home versus purchasing an established one. But that's not all. Nadia is a busy mum of 3 little ones, all under the age of 5. Juggling her thriving business with motherhood, she also finds time to serve on the fundraising committee for her local kinder, all while celebrating the joys of being part of a large, loving Italian family. So let's dive in and learn from Nadia's experience as we explore today's topic, building new versus buying established. Nadia, welcome to the show.
Thanks for having me, guys.
It's great to have you here, Nadia.
Very excited.
It's great to have somebody with your level of experience, not only professionally in property, but also on a personal level. Obviously, you're quite involved in purchasing properties. But tell us a little bit about your background and how you ended up, in the role you're in today.
Yeah, definitely. So I have been in the family business since I was little, since I could read and file, basically. So that's where I started.
Child labour.
Yeah, it was, for sure. And it was just sort of a natural progression to do accounting in uni. And then I started working in the business straight out of school. I did accounting for about 10 years. And then the opportunity came up to move into a mortgage brokering role just as a support to start off with. And then I really loved it and I didn't want to do accounting anymore. So in came mortgage brokering. But I still actually have my CPA because I wanted to keep that level of, knowledge relevant because it plays such a big role when we talk to our clients to be able to advise them on
100%.
both.
I guess it gives you a very unique perspective that not a lot of brokers have to actually understand, when you're talking about something, the tax benefits that go with it and also how that works from a finance perspective as well.
Yeah, exactly. And getting the structuring right is a big one.
And I guess for an investor client, that sort of knowledge would be invaluable to them actually structuring their investment portfolio the best way possible.
Yeah, definitely.
We've often got to get your broker and your accountant to discuss how to set this up. So
yes,
it's great if you can give advice on both.
I just take the hat off and put the other one on. Yeah,
that's it.
Yeah.
And then obviously, as I mentioned before, personally, you've got a bit of a property journey. Do you want to share that with us and what have you lived in or purchased as properties go?
Yeah, definitely. So my first property was actually a joint dual OC with my sister that we built. So it was up in Gembrook, which is where I still live now. It was a beautiful, massive property, but like I said, it was dual OC. So we wanted to get into the market. My sister had already owned a property before. I hadn't, so I missed out on all my first homeowner grants, but it definitely paid off because we built, a really nice property together.
I guess you made a lot more back in equity than you would have from the grant anyway.
100%. So then once we did that, we were in there for a little while and me and my husband built a property in Pakenham together as an investment, which we ended up selling off the plan because an opportunity came up to purchase an established home, still in Gembrook, that we just wanted to jump on. It was a really nice property. So we sold up basically and then bought this one and been there ever since. And then now we're building another one out in Ballarat. So, yeah.
There you go.
I guess that's a very interesting start to your property journey you talk about there because that co-living type concept where homes are now being built to accommodate individual people living together as in different siblings who want to buy a home together, for example. It's becoming a lot more prevalent. And so you're almost ahead of your time a bit there in actually building something like that.
Yeah, definitely. And it was really easy to sell too because it suited like a family that had older parents that they wanted to keep with them to look after them rather than them going into a home or something like that.
That is true. I mean, we have the co-living product there and we do see a variety of different buyer types who look at it. It's not just individuals wanting to buy a home together, but that layout with multiple bedrooms with en suites works for a lot of different people now, as you say, in the community. But I think it's a great way to get into the market for people who maybe aren't able to do it on their own.
Yeah, definitely. It was a lot more affordable and it meant that it made our first investment property a lot more affordable because we were only paying half of basically our own house.
That's true.
So, yeah.
Well, if it's a way to get into the market, then it's better off doing it that way.
Yeah, 100%. Yeah.
So from a broker or lending perspective, is there any difference between buying an established home or building a home?
Yeah, definitely. So if I start with, say, an established home, so obviously the time factor is there, so you can get in as soon as you want, really, or as soon as you can find something and settle. So you've definitely got that time difference. Obviously, with a build, it's a lot longer process. On the flip side, though, when you're buying an established, depending on whether you're a first homeowner or not, or an investor, there's stamp duty implications that we need to consider.
Yeah.
So they're obviously a lot higher under an established compared to when you're building.
Yeah, for sure.
Yeah, so there's probably the main differences between the two.
Well, I guess, obviously with that first home buyer and the stamp duty concession, could you explain a little bit more? There are caps, there's limits.
Yeah.
Explain how that works for the listeners.
Yeah, definitely. So whether it's established or you're building, so basically the stamp duty phases in from 600,000 and then all the way up till 750 is a sliding scale. So once you get to 750, you're basically paying full stamp duty as if you weren't a first home buyer.
Yep.
Whereas if you're under 600, then it's nothing. And then anything in between, you just get that concession all the way up.
And I think one important thing to take into account here is when you're purchasing house and land, the way that's calculated, which is different to when you're buying an established property, if you were to go into that a little bit more for us.
So when you're buying an established, it's just on whatever the market value is, whatever you paid for it, that's where the stamp duty is calculated. Obviously on a build, it's just on the land component. So if your land component is 300,000, 400,000, 500,000, you're not going to be paying any stamp duty because you're under that 600.
So as long as you're under 600 on the land value, you'll be paying no stamp duty.
Yeah.
So for a client then who maybe has a borrowing capacity of 8 or 850,000, if they wanted to maximise the property they can get while still paying no stamp duty with a new build or house and land, as long as they keep the land component under 600,000, they'll still pay no stamp duty on the purchase.
Yeah, that's correct. Yeah.
But if they were to build a house and the total package was, let's say, 900,000 and the land was 600,000, the build was 300, would they still reap these benefits?
So you'd still get the stamp duty concession, but you won't get like your first homeowner grants, so the $10,000 because you're over the cap of 750.
Yep.
So, and the same with the other schemes like the home guarantee scheme and things like that.
Yep.
We've got price limits that we need to apply.
Because we often get people coming in to build their first home and they're capping their house and land budget to 600,000, making sure they're getting the benefits, but they can obviously spend a little bit more and go up to that 750.
Yeah, that's right.
And then we mentioned that $10,000 grant there. Do you want to explain a bit more about what that looks like as well?
Yeah, so when you're building your first home, if you meet obviously the eligibility criteria of a first home buyer, then you're eligible to get the extra $10,000, which is part of your build. With most lenders, we can't use it as a part of your genuine savings because it's forms on top, but it's a really great buffer. So we always like to factor in a bit of a buffer. So when you actually do move in, you can pay for furniture or your expenses that are coming up.
Extra 10,000.
Exactly.
And does that apply to established properties?
No, only for build.
Right. So if you're building a home, you can get the $10,000 plus save on stamp duty as long as you stay within the thresholds. If you're buying established, you still get the stamp duty benefits under 750,000, but you're not going to see the benefits of the $10,000
No,
grant.
that's right. Yeah. And you'll still pay a little bit of stamp duty if you're going all the way up to the 750
Of
mark.
course you will. Yeah,
exactly.
You'll just get some.
And it is hard to get a property under 600 unless you're sort of going out of skirts.
That is true. It gets harder and harder, I think.
Yeah.
I mean, what other government grants or schemes are out there that a first home buyer, whether established or builder, could look at to take advantage of?
Yeah, we often compare either doing a home guarantee scheme, which is you just have to have your 5% deposit. You don't have to pay any lender's mortgage insurance, which I'll go into in a minute, compared to like a family guarantee. We often play them off against each other and see which one's better for the clients. Most of the time, clients like to do it on their own if they can. So the home guarantee scheme is great because, like I said, you just have to have that 5% deposit. There's still price caps that we need to adhere by. So depending on your area, it just changes. So it's best to get that checked first. But the lender's mortgage insurance is what you're saving on under the scheme. So it's almost like you've got a parental guarantee, but the government's backing you instead of your parents. So the mortgage insurance side of things, it's basically that just protects the bank. It doesn't protect you in any way. It just means that if you default on the loan and the bank has to sell your property, it's insurance basically to cover them for any shortfalls.
And for clarity here, that's only applicable when you're lending over 80% of the value of the property.
That's right. Yeah. So normally that's applicable as soon as your loan to value ratio is above 80, but under the scheme you can go all the way up to 95.
Is that a fixed amount?
No, it goes up as you borrow more basically, and depending on the loan amount as well. Yeah.
But if a first home buyer is then eligible for this scheme, they could borrow up to 95% and not need to pay for that LMI cost.
That's right.
Which could be a very significant saving for someone with a lower deposit.
Huge. Yeah. Well, I mean, it ranges. Like some we do that it's only like, $5,000. Some are $15,000. I did one that was $34,000. So it can be a big difference. Yeah.
And does that apply whether you're building or buying established?
For their scheme?
Yes.
Yeah, you can do it for both. Yep. So it doesn't matter if you're building or established.
And can you still get the first homeowners grants and things as well as the scheme?
Yes.
Yeah.
100%.
One other scheme I'm aware of, and it's probably not your area so much because it's through banks only, but there's the government's shared equity scheme as well.
Yes.
Could you explain a little bit about how that works?
Yeah, so this is similar sort of terms. You still need to have a sort of 2 to 5% deposit of genuine savings saved up for the property, but this is where the government puts in 20 to 25%. I can't remember what the exact figure is, but of the actual property. So they're buying in. So what it means is that if you wanted to pay them out at any point in time, it's at the market value of the property at that point in time that you want to pay them out. And there's a lot of different restrictions there.
So basically they'll own a percentage of the property.
Yes. Yeah.
So when would this be beneficial for someone to use?
It's good if someone doesn't have a high borrowing capacity. So if they can't borrow quite enough to get to the 95, and they've obviously still got the 5% deposit, then they can go under that scheme. It just means, like I said, that the government's owning a portion of it. So,
kind of like what you did with your sister, but with the government.
Yeah, exactly.
I guess ideally, if you're doing it with your sister, that's a bit more enjoyable than doing
100%.
it with the government.
Probably a little bit easier to get approval for like renos and things like that you want to do.
True. Yeah. And at least your sister would chip in.
Very true. Well, I don't know. It depends.
But I think an important one on the shared equity scheme, though, is for people who are looking to purchase a home and who need that scheme, it can't be used for new build. It can only actually be used for an established property because it requires there to be a certificate of occupancy in place at the time the purchase happens.
Yeah, that's right. And only a few banks do it as well, so you have to go directly to the bank. So, yeah, it's a little bit
restrictive in that sense. Yeah. But also, I guess, for some people who don't have friends or family to purchase with, who do have lower incomes, maybe owning 70% of or 75% of a property is better than owning no property as well. Yeah,
definitely. It's definitely a good step into the market,
Yeah.
even if it's a starting point.
That's true. Yeah.
Exactly.
But then, as you mentioned, there are other ways to get around that, like family guarantees that you would probably recommend over the shared equity scheme.
Yeah, so there's a couple ways. We've done a lot of either like parents buying with the kids as well. So if, for example, they don't have a high borrowing capacity, like we said before, like the parents can buy jointly, or a brother or a sister or whoever it might be, friend, buying jointly. That obviously they can pool their funds, they can pool they've got dual incomes. That helps with the borrowing capacity. But if the borrowing capacity is high enough for them to do it on their own, but they don't qualify, this is where we get it a lot. They don't actually qualify for the home guarantee scheme because their incomes might be too high or their property value might be too high. That's when a parental guarantee can be really beneficial because they can still avoid that mortgage insurance with their parents basically backing them with a separate property to make the bank's risk appetite a little bit more appealing.
So because it's between family members, there's no criteria as such you need to meet to use a family guarantee other than having a family member who actually has the equity in the property to offer for it.
Yeah, exactly.
Could you explain that a little bit more? Like, does that mean, do the parents have to cash out that money and put it into the purchase, or how does that process work?
Yeah, so there's no cash out or anything like that. The parents aren't responsible for the loan repayments or anything like that. The loan is solely in the applicant's name, so the children's name. What it means, though, is that the children are borrowing basically 100%, sometimes even more, 100% plus costs. So if you have no deposit whatsoever, or just a couple $1,000s or whatever it might be, you can still use a parental guarantee. We just did one recently. The purchase price was $485. They've borrowed $490, so they've borrowed more than 100% to help cover the transfer fees and settlement adjustments, conveyancing costs, all of that. Yeah. And then that way they've got into their home without having that deposit. So from the parents' perspective, their risk is if the kids default on the loan. So if the kids can't make their repayments, for 3 to 6 months, they go into hardship and then they can't, find a solution basically, that's when the bank would call upon the kids to sell the house, or the bank would foreclose it basically.
So the kid's house would be sold before the parents' house?
100%, yeah.
And would that be the first step? As soon as they miss those payments, the house gets sold?
Well, no, they'd go to hardship first.
Right.
So, yeah, it takes a little bit to actually get to the point where the bank will sell the house. And most of the time, the children would just sell the house, if they can't make the repayments.
Right, without the bank
Yeah,
needing to get involved
exactly.
in that process.
So the issue falls where they sell the house for less than what the loan outstanding is once you factor in all of the costs, so commissions and things like that.
Yep.
So if that happens, and say we used the example before, the property sells for like $450 and the loan outstanding is still, I don't know, $490,000, so it's $40,000 extra, and then we've got another $10,000 worth of costs, so we're about $50,000 short. That's when the bank would then call upon the guarantors, so the parents, to say, okay, you basically need to fork out the 50. How they do that is up to them. If they can't get a personal loan, or if they can't use their, savings or a sale of asset, whatever it might be, to pay out that 50, that's when the bank would then obviously have to say they'll sell the property for the parents, and then any extra proceeds will then go back to them.
And I guess you mentioned a personal loan, but there'd be the opportunity there maybe even for the kids in the family to go take that personal loan once they've cleared their mortgage that they're responsible for. So even the parents aren't responsible at all in the end.
Yeah, exactly.
So really the lender's looking for any other resource or way that this debt can be repaid rather than just selling properties straight off the bat.
Yeah.
And I mean, nothing's guaranteed, but if you're buying a typical house with some land attached to it in a city like Melbourne, I think, the risk level that would be attached to that would be quite low, as long as you've got the right advice and you're buying the right property type where you would anticipate having growth on it.
Yeah, exactly. And a lot of parents don't realise that it's not for the full 30-year loan term that they have to be a guarantor for. So as soon as basically that property value increases high enough and then they've paid their loan down and we're back to that 80% loan to value ratio, that's when we can take the parents off as guarantors.
That works quite well then.
Yeah, so sometimes it's within like 6 months to a year that they can do that.
So can that be used for an investment property as well as an owner-occupied property?
Yes, yeah, it can. Yeah. So if kids want to buy an investment property, same thing, they don't have the equity or the deposit, then they can use a parent's property.
So at the moment, a lot of the time for affordability, we've got first-home buyers coming to us, and rather than building their first home for them to live in, they're looking to rent-vest, which we've touched on in previous episodes. From an accounting perspective, so you can put your accounting hat on for this one.
Yeah.
Are there any tax benefits from building a new property and rent vesting?
Yeah, there is. So when we look at investment properties, a build has a better what they call depreciation claim. So depreciation is not a physical cash expense. It's just a tax write-off basically of the value of the building that you've built for the property. So when you're buying something that's established versus building, they've changed the depreciation laws a little while ago where that you can't claim the existing fixtures and fittings. So it used to be an extra depreciation claim that you can make on your tax return. So with the new builds, basically, because number one, the build value will be higher on a new build, and then you've got new fixtures and fittings in there that you can claim depreciation for. So that overall claim tends to be higher when you're building versus buying an established from a tax perspective.
Yep.
So generally that negative gearing benefit's a little bit higher because the depreciation claim's higher.
So essentially, if you break it down, the way they look at it is you've got a block of land that the house goes on. The land goes up in value.
Yes.
But the house that you've put on it, because it's getting older, technically the value of it reduces.
Yes.
Although the overall value of the combination of the two is going up. But I guess it's a lot like when you buy a brand new car and you drive it out of the showroom. The day you do that, it loses value straight away.
Right. It's diminishing over time.
Correct.
Yeah.
Because
straight away.
Straight away. Because the actual build itself technically has a diminishing value. You can claim tax benefits for that, but you're still actually making money based on the fact that it's a property.
Yes. Yep. 100%.
Which is a very unique way where you can essentially you could be making money but claim as if you're losing money.
Yeah, that's right. I mean, it does have its implications later on when you sell the property when we speak about capital gains tax. So if you have claimed depreciation over the years, we need to adjust that once you do sell the property. Right. So it reduces that cost base there.
But from a holding perspective, it helps obviously reduce your ongoing holding costs while you're getting that capital gain on that property.
That's right, 100%. And that's what we look at. We want to make sure that, the affordability is there, but a big part of that affordability is the cash flow, and tax can play a big part of that, especially if you're going to do a pay-as-you-go variation, for example, which is basically where instead of waiting till the end of the year to get your $10,000 refund, you can get it in each pay that you get from your employer. They just reduce the amount of tax that they withhold.
So instead of having to wait until you lodge your tax at the end of that year and being given a refund, you're essentially claiming that refund off each pay slip you receive.
Yeah, exactly. So if you paid fortnightly, less tax would be withheld. So your net pay in your pocket at the end of the day every fortnight would be higher, and that helps pay for the property, because obviously you're going to have investment property expenses throughout the year, not just once at the end of the year.
And especially for someone who might be like rent vesting, for example, where they've got the cost of the rental property they're in, technically being offset by the cost of the investment property they've purchased. You kind of need that spread throughout the year so that you don't have to pay it all up front and then go and get it back later.
Yeah. 100%. Yeah, it makes it much more affordable just on a daily basis. Yeah.
And what about then, we talked about capital gains tax. If I were, rent vesting or buying an investment for my first property versus buying a property to live in, what differences would I see there?
Yeah, so there's going to be, if you never live in the property and it's always been an investment, you're going to have capital gains tax from day dot. One strategy that some people use is that they move into the property for the first year and live in it there, and then that triggers the principal place of residence exemption, so you don't have to worry about capital gains tax. And then once they move out after that year, they've got technically 6 years where they can claim the main resident exemption for that same property, so long as they haven't bought another one that they're going to live in. But if they're renting, we'll go back to that rent vesting sort of strategy, they can basically just have that full 6 years where it's rented out and then not have to worry about CGT, so capital gains tax. And once you get to the end of the 6 years, they can actually move back in for a little bit, reset the 6 years and then do it again. So, yeah.
So
there you go.
Technically I could purchase a property in an area that may not be where I want to live. Mm-hmm. I could occupy that property for the first 12 months and then I could move back to my preferred location renting. I could build that property, claim my $10,000 grant if I'm keeping within the limits, pay no stamp duty on the purchase, and ultimately pay no capital gains tax when I sell that home too, while I'm having an investment property.
Yeah, exactly.
And having the tax benefits as well.
Yeah,
course,
exactly, at the same time, yeah. So long as you meet that 6 year residence exemption, yeah.
Are you able to just quickly touch on and give an explanation of what capital gains tax is for listeners?
Yeah, so if you have an investment property that's separate to your home that you've never lived in, basically it's a tax on the profit that you make from the sale of that property.
When you sell it.
Yeah, so at the point of time when you sell it, it'll be whatever the market value or whatever your sale price is. You minus off your cost base, so that will be the purchase price plus any other, legal fees and things that you incurred to buy it, stamp duty, things like that. And then the difference between the two is your net profit. If you've owned the property for more than 12 months, you do get a 50% concession on that. So say you made $100,000 once you factor in all of that, you're only going to be taxed on 50, but the way it works is that extra 50,000 is added to your taxable income. So if you're earning $100,000, the capital gain is, minus the 50% exemption is 50. Then your overall taxable income for that year is 150,000, and that's what you're taxed on.
Yeah, so your tax rate generally is going to go into one of the higher brackets or the highest bracket. So the tax amount is quite high.
Yeah, that's right. And it works well for older, if you're going to hold on to the property for a long time. So for example, or if you, for example, go on maternity leave or something like that, and your income that particular year is low, that's a good time to do it.
So we're looking at selling the property. Yeah, for
that's
sure.
right.
Yep.
Yeah, because it's your overall taxable income.
Well, you're going to reduce your overall tax there.
Yes, yeah. So strategic planning is good when we want to sell. So yeah, it can make a big difference to the tax.
But if it's your primary place of residence and then you sell it, you'll just pay no capital gains tax.
That's right.
So straight profit on everything.
Yep.
Are there any downsides to rent vesting from a tax perspective?
The only thing I can think of from a tax perspective is, either if you're going to hold it short term, so you're not going to get that, 50% exemption. So if you're looking at flipping a home or something like that, we need to factor in the tax for that. Mm-hmm. That's a big one that people forget if you're not holding it for the full year. Normally, though, rent vesting, it's not really involving flipping. It's holding on to it for a while.
Would you receive any of the the first homeowners grant for investing property?
I see. Yep. So no, you wouldn't receive any of your. You can't get the home guarantee scheme because you're not living it. You're not going to get your $10,000 first homeowners grant either. If you've owned that property, that investment property, and you didn't obviously claim your $10,000 grant, you can still actually claim the $10,000, I should say, later on. So if you've bought an investment property, had that for a while, and then you want to go buy your home or build your home, then you can still get your $10,000 there. The only thing that's not available to you is the home guarantee scheme. You can't get that once you've owned an investment property.
So the guarantee scheme is dependent on just having purchased property, where the first homeowners grant is dependent on having purchased a property you live in.
That's exactly right. Yes. Yeah.
So hypothetically, you could have 5 investment properties, and then your first property that you buy to live in, you'd still get your first homeowner's grant.
Yes, if you're building. Yes.
Yes. Yeah. If you're building. Yeah.
Or if you're buying under sort of the threshold as well, you could get away with no stamp duty on that purchase.
Yes. Yeah, that's right.
Although after 5 properties, you'd hope that you're not staying under the threshold.
Yeah, I was going to say, I think by then, you should have a good bit of equity to use.
I think on that, actually, as you mentioned, you can't use the equity schemes. But in saying that, if you're going through the process of investing in property, often the returns you're going to get from that will put you in a position where you're contributing 20% or more to a purchase anyway.
Yes, yeah. And you can use the equity. You can either sell the property. Sometimes it comes down to the borrowing capacity. So we've had quite a few clients where they had the equity there, but they just didn't have the borrowing capacity to hold both, have the investment property and the new home loan. So sometimes it's a bit of weighing up, okay, well, do I just keep renting, and hold on to that a little bit longer until my income's a bit higher, or you got a dual income, whatever it might be? Or do we, work out if it's the right time to sell and then use the proceeds to obviously
ultimately, it probably also depends on what you want to live in and what you're purchasing. Because if I was wanting to live in a brand new apartment, maybe I'd be better off renting that and actually buying a house and holding that as an investment property, because I'm likely to see more appreciation on the house, where ultimately my new apartment 5 years from now, it's just not a new apartment anymore.
Yeah, exactly. And I think a lot of people too forget as well, with equity, the bank's only going to lend up to 80% of that equity value without incurring the mortgage insurance. So if the property is worth $800,000 and the loan is $600,000, they think, great, I've got $200,000 to work with. They don't actually have that.
Only 80% of that.
Exactly. Yeah, that's
you
what
have to leave 20% for the bank.
Yeah, that's right. Well, you don't have to. You just have to pay the mortgage insurance.
That's true. Yeah.
Either you leave it or you pay for it.
Yes. Although there are a lot of schemes, like we're doing one at the moment. If you're a nurse, for example, and you're earning over a certain amount, you can go up to 90% and not pay any mortgage insurance. So
that's very good.
Yeah.
That's good.
Yeah. It's awesome.
Are there any other professions that would apply to?
Yeah, so there's a few, normally anything sort of medical, or even if you're a lawyer or an accountant or a doctor, something like that. There's lots of different what they call medico exemptions that we can claim. But the most popular one I think is for nurses. Being able to do 90% on an investment property too.
Would that
that's
be
great.
Because they're a lower risk borrower in the bank size, or?
Yeah, I think so. And obviously the work is, it's very secure. There's always overtime.
Yeah.
Exactly. Yeah, they can always do more.
That's true. Well, there's a shortage of
100%.
Yeah.
Yeah.
In your opinion, would you prefer to buy or build an investment property?
I think I'd prefer to build if it's for investment, only because, you can't kind of get around that stamp duty, concession there.
Yeah.
And also it's a brand new home, so it's easier to rent. The only downside, I guess, is that holding period. So you've got to make sure that you've, can afford that, the repayments and the costs while you're building.
Can you touch on just an overview of how that works from a lending perspective? Obviously, with construction loans, there's progressive payments.
Yeah, so the first one is obviously the land. So once your land settles, you'll have a loan straight away and have repayments that you'll need to make. Normally it's interest only, so it's a little bit more affordable than paying the principal as well as the interest. So it's interest only on the land, and then obviously once you get your build, you've got the 5 or 6 stages, the base, the frame, the lock-up, all of that.
Yep.
So as it progresses, the loan is just going to get higher and higher, basically, as they fund the builder throughout the process, I should say. Yeah. And then once you get to the end of it, that's when you're going to have the full loan expensed.
Yep.
You're going to have the full interest. It's still interest only, obviously, while you're still building. Depending on how your loan is structured, it can stay interest only. I always recommend keeping an investment loan interest only, especially if you have a home loan already, because your home loan is non-deductible. You can't claim that on tax or anything, whereas the investment loan is. So ideally, you want to be paying the smallest amount you can off the investment, and then any surplus income you're putting onto that home loan.
Yeah.
But basically, like I said, you just need to account for that, 6 to 12 months, probably more like 12 months of holding costs.
Yeah, for sure.
Yeah, throughout the build process.
Some of our clients really look at, from an investment perspective, they just want a property that straight away starts to generate a rental income, because in their mind that money that's coming through each week is profit back into their pockets. But often there's obviously, like you said, there's the holding costs. You've got to repay the mortgage. So our advice that we usually give to our clients is look for properties that are going to have a lot of capital growth, because really where you're generating the income from in the future is the value of that property appreciating. So it's a really hard discussion when we're speaking to people, because they're just thinking about the rental income, not the sort of longer term performance of that property.
It's that sort of second order thinking where it's not the immediate benefit that you're getting, it's the long term benefits.
What's hitting my account weekly?
Yeah.
That's what a lot of people are thinking about.
Yeah.
So.
And I think if you can meet those holding costs, the benefits, like I said, you've got depreciation benefits, you're going to have stamp duty benefits. There's a lot there. And it's a newer property, so you're not going to have like repairs and maintenance as much as like an established one. Yeah, so there's lots of benefits there.
With a lot of investments, you might actually be out of pocket weekly while you're holding the property, and then you somewhat can offset that with your tax benefits, for example. But you're making the money on the long-term capital growth, not on the weekly rental income.
That's right.
And I think a lot of people get confused about that when you're investing in property, you're not doing it to make $20 a week extra on what you were making before. You're doing it because over the next 5 years, that $600,000 house could be worth $700,000 or $800,000 if you're buying in the right location where there's demand for property.
And generally it's a bit of a trade-off between the rental yield, so the return you're going to get from rental income, over the capital growth of the property.
Yeah, of course.
Yeah, and most of the time capital growth is the way to go.
Yeah. Well, there's some property options out there like NDIS, for example, that's having a bit of a bad rap at the moment, and obviously very high rental yields, but the capital growth on some of those properties to resell an NDIS property that's been built for a specific reason is going to be quite difficult.
Yeah.
It's not going to suit a normal family.
Exactly.
And then we mentioned the out-of-pocket expenses. As a broker, is that something you can help look at with as somebody who's looking to buy a property and go through those figures and make sure they're comfortable with where their position will be? Yeah,
especially if they're renting at the same time. We always make sure that we've got some sort of a buffer in there in savings, or at least savings capacity. So we see what they're earning, what their expenses are, and how much they're actually putting away after rent and the other expenses. So we want to make sure that that's enough to cover the holding costs of the property whilst they're building, because, they've still got to obviously meet their normal everyday living expenses, unless they're going to move back to mum and dad and not have, the rental expense.
Which I guess if you're wanting to invest in something like new build where you don't get an immediate return, that could be an option too, to spend a short period of time living with a family member to allow that process to happen.
Yeah, and I think that's the main thing really that most people I think a lot of people are aware of that. It's short-term pain for long-term gain.
Yeah,
true, very true.
Yeah.
I think when you're entering the market, though, there's already so much to think about that people are only really thinking about what's happening tomorrow, not what's happening in 12 months' time. So it is important to get that information and provide yourself with that education so you actually know what you're getting yourself into.
Yeah, definitely. And there's so much more that goes into it that I think you don't know what you don't know.
Well,
so until
true.
you get the advice, it's like light bulbs go off.
That's true, yeah.
But I guess on that advice topic, when would you recommend is the best time for someone who's thinking about getting into the property market to come and speak to a professional and get the advice?
Yeah, we speak to, especially like first home buyers, sometimes it's like 6 months to a year before they're even ready to buy. So I think it's a really good idea to get the advice as early as you can, or as early as you start thinking about doing something, because number one, you might get there sooner than you think, or there might be ways to get in that you didn't realise. Second of all, if there's not, you can put a plan in place now that, yes, it might take you 6 to 12 months, but then when we get to the end of the 6 to 12 months, you're ready to go. You know what I mean? You're not just waiting and saying, oh, well, I'll have to save some more. I don't have enough now.
You've got an actual goal to work towards in that time instead of an open-ended goal of just saving to buy a property. But I guess for someone who's saving, if they don't have the income, they're saving to a pointless goal essentially. But without speaking to someone and getting the advice, you wouldn't really know that.
Yeah, exactly. And sometimes it's just opening up the opportunities for them and explaining to them, look, you can do it with a friend, or you can do it with a sister, or anything like that. A family guarantor,
all the things we've discussed today, if people didn't have the education on these things being available to them, in their mind, they're just not ready. But maybe they are, and if they come and have that discussion early, I suppose it's your job as a broker to find a solution, and if there isn't one immediately, then you can quite easily put a plan in place and help people actually reach those goals.
Yeah, exactly. And I think it's more important to have the goals in the first place. So then you're working towards something rather than just just kind of going through life with
Open-ended, just being like, I'm
Yeah.
saving money because I know I need to, but I
Yeah.
don't know how much I want.
Exactly.
Yeah.
Or some people don't realize like they only need a certain amount too.
That's
like,
true. Yeah.
Yeah.
We often get people come in and go, well, we just don't have 20% yet, so we're not ready. But they don't need 20% to buy a property, and to
That's
save
right.
20% could take years and years.
Yeah, especially with the property prices
That's
increasing.
true. Yeah, look, you're chasing your tail.
You'll never catch it.
Yeah, that's right.
So if I'm interested in the idea of buying property, but I actually don't think I'm in a position right now, you would still be happy to book a time and speak to me and actually look at that.
Yeah, 100%. Because like I said, sometimes it's just that education piece. Like it's just saying, okay, well, it's not going to work now, but this is what you need to get there. Or even just like, in 5 years' time, their income might have increased, substantially. They might have got a new job or a new role. And then that, because they know in the back of their head, okay, well, I needed to be earning $80,000 or whatever it might be. As soon as they get there, like, oh, now I am. You know what I mean? So
they've got the knowledge to actually plan and prepare properly for what their goals are.
And in the meantime, they've been saving, because they know what sort of property they want to buy, all of that.
Yeah.
So it makes a huge difference.
So, there's a lot of discussion about interest rates, and there have been for the last 18 months or whatever it's been. But coming into the new year, there's a lot of talk about interest rates dropping. What does that actually mean for somebody if they're a first-home buyer and they're looking to enter the market? Like, how does that benefit them?
Yeah, so obviously lower repayments it makes affordability a lot easier, but also the borrowing capacity increases. So as we have a rate drop, obviously the assessment rate drops as well. So what the banks do is, even though the interest rate might be 6%, most of the banks will assess you on either 2 or 3% higher. Some are 1%, but most of the ones we look at are 2 to 3%. Yep. So if the rate's 6%, they're actually assessing you at 9%.
Because they're allowing for any rate rises that may happen.
They're very conservative.
Yeah, of
banks
course.
Are.
Yeah. Well, they need to protect their money.
That's right. That's it. So obviously, as the interest rates go down, that buffer also comes down.
So what that means is then people can actually go out and afford something. So we obviously talk about affordability, and property prices are quite high, but as those rates drop, someone's borrowing capacity increases, and it might allow them to actually go and purchase something.
Yeah, exactly. And sometimes it's, can be, 10,000, 20,000, sometimes more. Things like even credit cards and other car loans and things like that. So even if you might not be in a position now, like I said before, as part of that plan, we can say, oh, well, let's, get you into a good position. So, we pay down that car loan, we get rid of that credit card, because those things also make a huge difference to your borrowing capacity as well, which people just don't realise, because they think if they've paid the credit card off, then they're good. They're not using the limit, but the banks will actually assess
They still assess it on the limit.
Yeah, they will. Yeah.
Because you have access to those funds at any time, essentially.
Yeah, you could go out tomorrow and go spend that whole $10,000. Yeah.
I guess from a property perspective, though, the other thing that happens sometimes when you get an interest rate drop, everyone else's borrowing capacity goes up too. And so then what you start to see is people can spend more on homes, and they start pushing the price of property up. So even though you can borrow more, potentially all you end up doing is paying more for the same property, rather than if you purchased in a market where interest rates are higher. So sometimes I guess as long as they're comfortable and they're comfortable with where they're being assessed at and the repayments there, if you can buy when the interest rates are higher, you might actually end up getting yourself a better deal than if you buy.
Well, that's why we're seeing a lot of investor activity at the moment, is because they're banking on basically that happening.
As the interest rates come down, prices will go up.
And if you're buying in a market now where the prices are relatively affordable, especially in Melbourne right now, and then you take out the loan on the higher interest rate, when the rates drop, you can refinance and take advantage of the lower rate, but you've bought in a softer market rather than paying the maximum price for a property.
Yeah, exactly. And there's a lot of people that are keen to sell too, because affordability is not there and there's not a lot of competition. So you can definitely, there's a lot more room to negotiate, I feel, in this current market.
So it's a buyer's market right now.
Yeah, for sure.
Good to know.
Yeah.
From that point of view, I guess, if you were talking to a first home buyer out there today and they were looking at getting into the market, what would be the main piece of advice you would give to them?
I think the main thing is just find out exactly what you can do now. So what your borrowing capacity is now, what your savings is. So like I said, you can either put in that plan of action now, or otherwise, if you're ready to go, it's a great market to go and buy. Yeah.
And what's the best way that someone could actually do that?
To get in touch or to actually go and buy the property. Explain your question a bit more.
I guess my question is, obviously, the best thing they could do would be to make those investigations around whether what they can do. should I jump online? Should I use the online calculator?
I see. Yeah. Okay, gotcha. Yeah.
But it's said I can borrow $1 million.
Yeah. Oh, we see that all the time. If anyone wants like a little quick tidbit, it's generally your borrowing capacity is about 4 to 5 times your income. Obviously, it doesn't factor in all your other debts, things like that, but it's a good starting point. But it's best to get a proper, assessment done. It doesn't affect your credit reports or anything like that. We can all, we can check everything that the banks would check anyway. So if you've got a broker, definitely speak to your broker because they're the best people because they can look at all, we've got over 60 lenders on our panels and plus more off panel. So there's so many options.
You said before, nurses can borrow up to 90% and avoid LMI. If a nurse goes into one of the banks, let's say, maybe they don't offer that product.
Yeah.
And they don't know that unless they speak to you.
Or the online calculator doesn't know that either.
Exactly. That's right.
And as a broker, would you charge a client for doing that?
No, we don't charge for initial consults or anything like that because at the end of the day, we're in the business to help people.
Yeah.
I mean, we get such what's the word that fuzzy feeling. You know what I mean?
You're helping someone. You're giving them the means to actually go and achieve that goal, buy that property. Yeah, I'm sure it is.
And I think that's why I ended up moving out of accounting and into
not as rewarding.
Less fuzzy.
Here's your tax return.
Most people like getting their refund though.
Oh, the refund's good. Yeah.
Normally though, it's tax payable because you're earning more money. It's a good thing too. Like if you have to pay tax, that's actually really good because it means you're doing really well.
We often hear that people are like, "Oh, I earn more. I need to pay more tax." But you earn more.
Yeah, exactly.
Correct.
Yeah, you're keeping the majority of that money.
Yeah.
But I think on that, it's a great opportunity for people looking at getting into the market that they can get that professional advice free of charge and they can be 100% confident in the plan they're making and it's not going to cost them anything to do that.
Exactly. Yeah. Yeah. Education is free and it should always be free.
Great advice.
Thank you.
Thanks for joining us today, Nadia. It's been great having you on. I think it's been very insightful for the listeners. I think, anyone listening today would have taken away a lot more understanding of actually how do I get into a property and what's the right property type for me to purchase. So great to have you here.
Thanks,
Hopefully
Nadia.
we can get you on again.
Thanks, guys. I really appreciate your time.
That's a wrap for today's episode of Building Your First Home, brought to you by Turnkey Building Group. We hope you found our discussion insightful and feel more confident as you embark on your home building journey.
If you enjoyed this episode, please subscribe to Building Your First Home on your favourite podcast platform. Also, follow us on social media at Turnkey Building Group for the latest updates and home building tips. We love hearing from our listeners, so feel free to share your thoughts, experiences, and any topics you'd like us to cover in future episodes. Thank you for tuning in. Until next time, have a great day and happy building.